Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly market update. Sorry, coming to you a little bit later than usual in a week, but just wanted to give you an update on the stats. Let's jump right in and take a look at what's going on. I'm going to give you some quick stats first because I kind of want to set this up for going into more in depth on the information. But some big changes in the market. We're 31 days closed on market, which is pretty close to where we were last week. We're right around 30 days on market. So things are still pretty brisk. But with that said, we are at 3.19 month supply. Now, if you haven't been following, you're not sure what that means yet. Let me just stop there for 1 second. That means if nothing else were to come on the market, it would take a little over 3 months, 3.19 month supply, a little over 3 months to get rid of all that product, all the houses on the market. It would take a little over 3 months. Now, up until about March, April, around March 11th is when things really started changing with a huge surge in inventory that we got, along with interest rates going, continuing to go up and things like that were affecting the market. And we had a little bit of FOMO going on, which I talked about last week. I'll talk a little bit more about today. But fear of missing out on sales. Whenever interest rates go up, usually we see an uptick in supply. And the reason for that is just like for buyers, for sellers, interest rates also affect what's going on in the market, right? In the housing market. Because if interest rates go up, obviously, if they're going to be thinking about buying something else, which maybe isn't the case with these sellers, which I've kind of brought up before in the last couple of weeks, talk more about today. But they're also thinking on the seller side, this may affect demand, right? It's all about supply and demand. It's all about supply and demand. You can make the market, you can wish the market was doing what you wanted to do even just a month or two ago, maybe 3 months ago. It doesn't matter. It may have already passed you by, so to speak. So it's really important to be realistic on what's going on in the market, or kind of hold off and wait if that's what you need to do. You need to do what you can afford to do, what's best for you, and what's going on with your finances, right? So that's why it's really important to kind of dig into this and figure out what's going on and what works best for you. Now, so with that said, last week we were just over 2 months supply last week. And during the crazy insanity phase of the market where things were selling like nuts, and rates were at 3% just a year ago, and a few months back rates were even were lower than where they are now. We were at like half month supply, 0.7 month supply. That was pretty typical. Even before the pandemic, we were right around just under or just over 2 months supply, depending on where things were. And then things got it kind of janky after, we went into the whole COVID thing the last couple of years. So here's where we are now. This is what we need to look at. Where we are now is at 3.19 month supply. That means we're basically in pretty much a balanced market. I've been telling you for quite a while that, a pretty brisk market is that 2 to 3 month supply. But once we get into the over 3 going into 4 month supply, now we're in a super balanced market, going into a buyer's market once we start getting into that range. So we've got to really pay attention to these things and understand and be realistic when we're trying to sell a house or when we're trying to make moves and do things. This is just where the market is. So that's why we like to keep an eye on it, every few days or every week. So the absorption rate was 31.3%. That's certainly down quite a bit. We'll talk more about that in a minute. The average list price was $737, and the average sales price is at $559. Now, the last couple of weeks, that's kind of gone down, gone up, gone down. But keep in mind, you've got to kind of compare apples to apples. This doesn't mean that your appraised value is going down on your house. Chicken little, the sky is falling. What it means is something specific, which we'll get into in just 1 second here. The list to sales price ratio is still very healthy at this week at 99.19 in this past week. Right now we are up on our active listings. We're up 10.6% from last week. we're sitting at over 16,000 in inventory, right around 17,000. And our short sales have ticked up just a little bit, but like 24 short sales, that's still Zippo. So sky is falling. No, we're not crashing yet. So we're good there. We're actually gone down 11.1% on short sales. Um, and if we look at new listings that were taken, the new listings that were actually taken, the active number was the first number I gave you at over 16,000. We took over 2,500, 2,541. Now, anything over 2,500, that's good. That means we're feeding the market with more homes at a healthy pace. That's 25 over 2,500. So we're right there. But we are down a hair on that, down about 8.5%. Not a huge amount, but we're down a little bit. But there's just not as many people on the market. How do I know that? Well, the number of pending properties, or those that have gone under contract, is down 8.4%, down at around 3,586. So just last year we would have been over 5,000 this week. Year over year would have been over 5,000 this week. So big difference there. There's a little bit less people in the market, and of course interest rates and prices going up has certainly changed things for a lot of people, right? So the closed days, the closed units are down 28.9% month to date. We had 1,159. And one thing I do want to point out here that's really important is the fact that the biggest jump in inventory happened at those properties under 500,000. Okay, we are at the whole MLS as a whole. We are at 47.48%. That's up a couple percent. We've seen there in that price range of inventory. So when we are looking at the average sales price, nothing to be alarmed about. We're still way over where we were last year. We're still healthy. People aren't losing their shirts or anything like that. Everybody's got plenty of equity. But the difference is homes in that lower price range, in that under 500,000, those are the ones that are being put on the market. Those are the ones that are more affordable. Those are the ones that are kind of moving a little bit quicker. So that's kind of what that means and where that puts us there. So what's driving the market? Again, supply, demand, interest rates. Housing, the jobs market was better than projected, but it's still, it's still kind of lower than where we'd like to see it. We're kind of not. It's almost like they're not expecting much on Wall Street in the way of jobs numbers when you stop and break it down. But it was over where it should be, and some of that is, a lot of the COVID attrition still, and those sorts of things going on, of course. But that said, the interest rates are obviously going to be the issue. We're going to see another across the board, without getting into too far on how the economics work, another 75 basis point hike. Honestly, these interest rate hikes overall, and it's not just on mortgage interest rates. It's interest rates across the board on all kinds of things that deal with credit and all that. But the Federal Reserve that's how they're fighting this inflation, these inflationary factors that we have due to energy costs, issues that and ideologies that we're dealing with right now, to be blunt about it, that are basically driving the cost up for energy prices, your heating and cooling bills, plastics, just running an electrical grid, all those sorts of things, getting food to stores, all that kind of stuff just costs more when you're trying to go to renewable energy, when it's very costly, and we're not quite there yet, honestly. But that's where we're at. A lot of the oil fracking, natural gas that we have today with the new technologies actually cleans pretty cool. But we've got a war of ideologies going on, and we're paying for it, and that's just the way it is. So until that changes, and we start producing our own, meaning more refineries, more coal. We have a miracle in green energy renewables, where we've got Germany actually opening up coal plants because the windmills and the solar didn't quite cut it. Okay, so that should tell us what to look out for when it comes to those sorts of things. Maybe we're just not quite there yet. Not saying we'll never be, not saying we couldn't be, but it costs money to shift a whole industry like that. So I think we got to be more realistic there, because the inflationary factors are also another factor in what people can afford in a home, right? So since we're talking about the housing market, we got to talk about these things. Now, in the Phoenix area, our jobs market is actually, and our economy is still very strong. We actually have nuclear plant here, which is great, powering us. We actually have, a great jobs market. We have a lot of them, the Taiwanese, we talked about this last week, microchips coming here, which is great. We've got a lot of different tech companies and businesses coming here, of course, and hospitality industry. We have military base here, so there's a lot going on. We have universities, all kinds of stuff, and full spectrum of sports here. So we got a lot going on, but our jobs market, our economy is really strong here, and thankfully we have really strong energy. But we're still paying high gas prices, right? Because we need to open up those leases, those permits, and get that oil flowing and get them into the refineries. Okay, just real life adult stuff, guys. But anyways, that all affects what people can afford, right? So if we look at the home ownership, just in the past week, got a little bit cheaper because rates did fall a little bit. And that's pretty typical when we're getting ready for another hike, believe it or not. Especially since they can't decide whether or not we're in a recession officially. We're in a recession. I mean, everybody knows it. And we'll talk more about that in just a second here. But a year over year, and we're looking at in the last week $100 savings in a typical monthly mortgage from the National Association of Realtors, but a 5% more affordability in interest rates from the short little period of drop we had from 5.3 to 5.7. Now, again, I've seen rates as high as 6 for FHA and for conventional loans out there from some retail mortgage companies out there. I would highly recommend a mortgage broker. They shop the best rates. I would highly recommend ours. I'm a little prejudice on this, but Modern Home Lending is our preferred lender, and I would say reach out to us. We can put you in connecting you with one of the loan officers here that would be able to help you with that. But we're just noticing, only because we want the best for our customers, we're just noticing lower fees. We're noticing a quarter to almost a 1%. I just can't understand what in the world is going on with some of these retail mortgage companies, but they're charging over 6%. And we've got people, FHA loans in the 4s, conventional loans, they're in the high 4s to low 5s. It's just crazy. So anyway, last year at this time we're at like 2.9%. So that's a huge difference from year over year of what people can afford. And obviously prices continue to go up. So those are all factors of what's driving the market. Now, here's the one question that we should be asking ourselves, because if you know anything, and what we've been saying right along here is that whenever we do hit a recession, a bad economy, the interest rates, with inflationary factors, the Fed will raise the interest rate. But then once we get into the recession long enough, they will lower interest rates. So let's take a quick look at that really quick. I think I may have gone through some of this before, but it is worth repeating. Okay. In 1980 recession, we had 6 months where interest rates were all the way up to 16%. And within 6 months of that, they went down to 11.8%. The recession from 81 to 82, that lasted from July of 81 to November of 82. That was a whole year and 4 months, went from 18% to 13%. Okay. In the early 1990s recession, from July 90 to March 91, that was 8 months, went from 11 to 8.8%. Early 2000s recession, we had March of 2001 to November of 2001, 8 months. That was 7.4 to 6.8. The Great Recession from December 2007 to June of 2009, that was a year and 6 months. Okay. And by the way, two of these were caused by the housing market. That would have been the one from in '07 to '09, and then there would have been the one back in the '80s. I'm sorry, in the '90s that dealt with the housing market actually causing the issue in the recession. But we're not dealing with that right now. The housing market isn't the issue with the recession, right? So keep that in mind too when we're dealing with sky is falling. Every recession means we're going to have a crashing market, and these shall we say not very well informed people on some of the major news stations that go on and on, whether every recession that there is, where we see we're going to have some sort of crazy stuff going on. They can't decide whether or not we're in a recession, we're in stagflation or not, when we already knew these things were all coming because of some of the energy policies back a year and a half ago. So again, take it with a grain of salt. They didn't call the '07, '08 thing, and so on. So we are where we are for real when you look at the facts of all that. And what that means is, we had a year and a half there back at that Great Recession in the crash when we did have the housing crash, from 6 to 4 point, went up to 6, then down to 4.9. And honestly, anything under 6 or 7 historically is not a horrible interest rate. So we kind of got spoiled with those 3s and 2s and 4s for quite a while there, those low 4s. But they'll be coming back. We were just dealing with some of the conferences that we go to. Well, we had one this past week with one of our brokers went to, and everybody in the industry sees this again with this recession, that it won't take very long. We'll have lower interest rates again. Now that's great if you're going to refinance, but should you wait to buy? Well, with interest, with the interest rates and everything, you can refinance, of course, into a lower interest rate, and you can usually do that with no money out of pocket. Also, you're looking at keeping your monthly payment down, lock it in now, so to speak. And also you're looking at not gaining any equity if you're renting. Now, if you already have a low interest rate, and and again, this is all if you can afford it, of course, but if you already have a low interest rate and you're thinking about selling and then buying, well, then maybe you might want to wait a little bit, unless you can afford to do it and you just want to get moving on with things. Because again, the interest rates are not as horrible, historically speaking, than people make them out to be sometimes. So anyway, that said, again, to put this all into context, that was the longest from the Great Recession, the 1 year to 6 months, 1 year and 6 months, so 18 months, from 6 to 4.9%, which again are not horrible interest rates. And then the COVID recession from February 2020, April to 2020, that was about 2 months in there, where we had that short little recessionary period with a lot of the stuff that was happening with the COVID deal, the lockdowns and all that. So we went from 3.8% down to 2.8%. So anyway, just a quick rundown on that. I don't want to spend too much more time on that. I think that basically explains what I'm getting at with, recession. Here's how long it will be in it. You have a bad economy. Interest rates may be higher to deal with inflation, but the point is, once we're in that recession, we're in a bad economy, rates will come down to combat that or counteract that. Okay, it's just how they work the economy. Okay. So now, we talked about this before, the contract ratio. This is a factor that gives us a little bit more of the now factor of what's going on in the market. We'll talk about the CMI in a minute, the Cromford Market Index. Again, all this comes from the Cromford report, but these numbers on the contract ratio basically let us know a little bit quicker in a volatile market, a very changing market like we're in right now, what's going on. So if we're between that 30 to 60 range on their index for this contract ratio, looking at those, basically this is looking at whether or not we're, in a balanced market, what's going on there, actives versus, what's under contract. 30 to 60 is kind of in the mid range of that. And right now, we are looking at the worst in this range. It's going to be Sun Lakes for our area. Again, we're talking about Phoenix mainly here in our market updates, obviously. Sun Lakes area is at contract ratio today of 35. They were at 276 just 1 year, I'm sorry, 3 months ago. 3 months ago. The number one on this list is Paradise Valley. Right now, they're I'm sorry, not Paradise Valley. Arizona City right now is at 188. They were at 509. They were at 509. Okay. So some of the other areas, I'll just rattle a couple of these off real quick. We're seeing that we're having a big drop in all of these areas are dropping. They're all pretty much headed or already in a balanced frame or market for this area for the Phoenix area. But some of the main areas, so to speak, of the valley are places like Buckeyes at 57, so that's right in that range. Tolleson at 91. We've got Scottsdale at 43. Okay, again, between 30 and 60 is balanced. Okay. And these are all changing just in the last 3 months since April. Okay. Avondale has changed quite a bit. That's gone down 84% from 340 in April to 54 now. Peoria 246 to 52, down 79%. And Goodyear is 321 down to 74. That's 77%. Chandler from 293 down to 48. That's 84%. Glendale 303 down to 50. That's 84%. Phoenix itself, Phoenix proper, 272 to 48. That's down 82%. So again, these numbers since April to now have dropped. And again, it's the whole metropolitan area. The whole metropolitan area has dropped, or it's dropping into, in other words, into a balanced market due to supply and demand, interest rates, and those sorts of things. So, and this is mainly looking at what's active and what's versus what's under contract, and how that's kind of balancing out, and what kind of a healthy market are we in for that. So we're seeing that the number of active properties versus the number of what's under contract is coming more into what would be balanced. Whereas before, you list a property, even if it needed full updating, and just because there was really nothing that could be, there was nothing else to choose from, people would just take it and figure that they would fix it up later, right? So now people have choices. When you go from a half-month supply, okay, when you go from a half-month supply, to over 3 month supply, things change in the market. And quite frankly, if you really need to look at the most recent comps, you've got to go by that when you're pricing things. You've also got to really start doing things like you would normally do in a normal market, and that is, what kind of condition is my home in compared to what's on the market now, what's under contract now, what just sold in the last 30 days, maybe 3 months at the most. But remember, in the last 3 months, things have drastically changed. So we've got to kind of go with that. And you also got to always keep in mind when you're listing a property, I keep telling people this over and over again, they want to list with these weird numbers and these weird things like 385 and 505 and this crazy stuff. And they're thinking, well, yeah, I want to list it for more and get more. But guys, a fire sale would be something like if we listed it, way, way, way low. Like a property is actually today with the current comps and conditions, let's say 500, and we list it for, 425 or 450. That's kind of a fire sale, versus just listing it at say 475 or 500. But if the current last comp, especially if it looks better than yours, sold for at or above where you comp at right now, I'm going to think about being in that next maybe bracket down, because people search in $25,000 increments. Okay. Or again, just hang out of the property. We're probably going to appreciate at least, around 8% this year, maybe 10%. The way things are going with the drastic changes in the interest rates and the economy for everybody's affordability. So those are just some things to kind of keep in mind. People searching $25,000 increments, and be realistic on where you are with the latest comps and what's under contract in the area. How long has that been sitting? How long did the last one go under contract? What did that look like? Okay, all those sorts of things kind of give you your trends of what's going on. Now, the actual CMI, the Crawford Market Index, again, kind of deals more with the supply and demand, absorption rates, kind of smooths things out, gives us more of the averages. And basically we're looking at Buckeye being in a buyer's market at in about another week here. Right now it's at 100. Remember, anything from 90 to 110, is in the middle or balanced portion of the Crawford Market Index. Anything over 110 is a seller's market. Anything below 90 is a buyer's market. Okay, so if you're between that 90 and 110, you're in balance. Okay, so right now Buckeye's at 100. Queen Creek's 107, Maricopa City 110, Peoria 136, Gilbert 137, Tempe 137, Chandler 139, Phoenix 148, Surprise 148. And again, all these numbers are down by over 30% on the Crawford Market Index. They're just, in the last week and last month, they've just really dropped dramatically. Glendale would be the most dramatic drop at 43%, and it's hitting at 161 on the Crawford Market Index right now. Goodyear at 163, Avondale is at 176. Avondale down 32%, Goodyear down 37%. Scottsdale at 185, down 36%. Obviously Phoenix, Scottsdale, two of the most popular areas of town. All of the cities are down. All of the cities are down on the Crawford Market Index. Again, and this deals more with your supply, your demand, your absorption rates, and how things are being listed and coming off the market, going under contract and closing out. Okay. However, one thing that we will show you, or we'll point out to you, is again, Buckeye is right there in the middle at 100. Probably in about another week or two, maybe a month at the most, Buckeye will be in a quote unquote buyer's market, meaning below 90. With Queen Creek and Maricopa coming right behind it. But we have gone down 34% compared to 35% in the last month. As far as how things have dropped overall on average. So 34, being at 34, it's kind of the lowest we've been since these numbers started dropping about 3-4 months ago. So keep that in mind. Since about April, really when all this surge happened was about March 11th. We got interest rates were continuing to tick up overall, and interest rates changed by the day, by the morning to the afternoon, by the week and the month, right? So they're changing all the time, but day by day. But March 11th, that's when we really got this huge surge of inventory, and it kind of stayed there along with the higher interest rates. So that kind of maybe bumps people out of the market, change some things, and obviously supply and demand drives any product. You can always take that to the bank. So overall, our Crawford Market Index is at 161, still over 110, still technically overall the Valley and Phoenix area, metropolitan area is in a seller's market overall. But as you can see, numbers are coming down. Demand is actually at 86.3. 86.3. So that means we're actually down about 3 to 4% there. We've got the overall index at 160.9. Supply is actually at 53.6. So that's down, it's down, 47% below where it should be. But, that supply has actually, even though it's surged, it's still below where it should be, but it's made a big difference in what's going on in the market. I mean, obviously, if people have more options, they're more willing to be like, well, maybe I can wait to sell my home or whatnot. Also, keep in mind, if the demand has gone down below 90, it's gone down that much. Yeah, interest rates affect that, but there's still this surge in listings, right? So what does that mean? Well, I pointed out last week that 55% of the sellers are either builders or new home sales, second homes. So people who come here seasonally for vacation or seasonal travel, to get out of the snow, in the winter and things like that. And there are also people who had short-term or long-term rentals or Airbnbs and those sorts of things. So again, when the interest rates go up, it's normal to get that surge in inventory from, the builders are always there. The builders have been playing catch up. They're having some issues, still with stuff, but their permit numbers went up, right? They're still having issues with tradesmen and getting supplies and stuff, but their permits went up. And then we have all these people with FOMO, fear of missing out, right? Interest rates go up. A lot of investors, unless they're just going to be in it for a long term, are like, a lot of people who got in like around the COVID deal year or two ago, maybe 2-3 years ago, a year ago, they're like, I think I want to get out now, since the interest rates go up. Again, that affects them because now they're figuring supply is going to go down. So when people sell homes, if they live in a home and they're going to stay in the valley, which a lot of them are, if they sell, they're going to be buying something, but the demand is going down, not up. So again, that's kind of what a lot of that is. So some of this could play out if homes are priced accordingly and they want to unload it. Again, got to be priced with today's market. 3 months ago, very different market. Even 2 months ago, you've got to look at how people search the condition of your home and where the real honest to God comparable appraised value is of your home today. The average appraised value of your home is today. You got to really look at that, and you got to be realistic about it. Okay, you can't go by what somebody sold something for prior to the surge in supply and before the interest rates were up another 0.5% or whatever. So you got to be realistic about that. But let's look at, and then you got this factor of this huge supply, but they're not buying your house. They're just unloading a house. Okay. So one other big deal here I want to bring up is median sales price. Almost all monthly median sales prices are below their recent peak. For Avondale's gone from 460 to 450. Okay. So that's a $10,000 difference in the median. And again, does that mean the average appraised value, the actual value of your home, taking into consideration condition, size, square footage, all that, whether it's a 1 or 2 story, what kind of updates does it have, the age, all that stuff, does it have a pool or not, all those sorts of things. And then we're looking at, but there's a surge right in that median category, right? Under 500,000 of new supply and activity going on. So we've got to keep that in mind. We got to be realistic on what's going on. Now, if you're okay with waiting, but what happens when a home sits too long, right? The home sits too long, people start wondering what's wrong with that house, right? So keep in mind, you've got to be realistic. Price with the $25,000 increment. Don't do 485. Do 475. Or if the last home sold, with multiple offers listed, at 450, you put it at, that 450 mark also to get those 2 or 3 offers like the last guy did. And remember, if those people were willing to pay for the guy down the street from you in this medium price range, they're probably still around. Maybe they're probably still around, but at least you'll be pricing it accordingly to the actual comp range and how people search in $25,000 increments on their realtors portals through multiple listing service or third-party sites that aren't as accurate, but that's just how they search in like Zillow, and all these other third-party sites. Okay. So Buckeyes down from 451 to 445. Chandler 630 down to 577. Again, these are median sales prices. These are not appraised values. Right. Again, we got a surge in at under 150,000. So it brings the overall average down, or median price down. All right. But that means you got to kind of go with that flow. And again, what people were doing during the crazy insanity market when there was no supply was they were saying, yes, the average appraised value is 450, but I know there's no inventory out there and things are crazy right now. So the high end of the comp is, 480, and I know people are paying 20 to 50 grand over that. And that's where people were pricing their houses. Guys, that's not going to continue on. And if your home doesn't have all the bells and whistles and the trends that people want today, whether you agree with them or not, guess what? It is what it is. I just want to make sure that we're being straight on the sales there. And the idea that, we can just price homes for whatever we want, those days right now are gone, unless we drop back down to that under 1 month supply again. Could have a heyday all over again. Who knows? Especially if the rates drop again, right? In the next 6 to 18 months or whatever. So let's see what happens. A few more of these. Gilbert down 554 down to 520. Okay, these are median prices here that went down from Maricopa City 415 to 410. Mesa 520 down to 500. Peoria 570 down to 550. Phoenix is down from 500 down to 480. Queen Creek 515 to 510. No, that's not too bad. Scottsdale is down from 1.115 million down to 1.1 million. Ooh. All right. Surprise is down from 494 and some change down to 490. Not too bad. And Tempe is down 585 down to 555. Okay. It's a pretty big one there. So guys, that's all I got for you today. There's a lot more I could say. I guess, just want to make sure I'm not missing anything here that I want to tell you guys. The active homes on market, again, we're getting that boost in inventory, especially under 500,000. That's the biggest surge we're seeing. Almost pretty close to half. Like I said, what was it? 7.48%. That's what's bringing down the median prices. It's not that your appraised value is going down. Chicken Little's not coming, and we're not having another housing crash at the moment. Okay. So, and we're not seeing any surge in distress homes or anything like that. Like I said, we had 24 short sales. Nothing crazy out there. And like I said, there's just less people in the market because due to the rates. Also keep in mind, especially in Arizona right now, we have excessive heat warnings every day. A lot of people who usually buy right around when school lets out or right after school lets out. Typically, it's kind of how it works here. April, May, part of June. Once we get into July, especially a lot of executives, they're a lot of people, they take their vacations. 4th of July, it was kind of the slowest week for us. We had of the whole year. July, August, a lot of people are taking their vacations. Also for us, I know it's different in every part of the country, but usually for us, first, second week of August, everybody's back to school. So then it's usually kind of quiet typically till we get to like after Labor Day, maybe the first week of October, and then we get the surge towards the end of the year. Everybody wants to move before the holidays are over, and or to get the tax credit done by the end of the year. And they're figuring that with their accountant, of course. So we do have less people in the market, from 3586 under contract now. Last year 5209, but there are things people can do, like ARM. Even there's a lot of different products out there now, like ARMs, 2, 3, 5, 10-year ARMs. So for that long, again, could you refinance out of it without penalties? Yes. If you know, are using a good broker. And they have things, you know, a lot of times we're seeing that a lot of buyers right now are asking for concessions even. So the longer you wait to sell your property until we kind of get back to, you know, a seller's market, the longer you wait, the you know, less leverage you're going to have as a seller for the time being, while people have more options, and you know, they're not so fast to move into a higher interest rate unless they need to. um, and we see this surge in inventory. So you know, a lot of people are even asking for concessions, you know, 3-4% concessions for you know, 2-1 buy downs, or to buy down their rate, you know. um, so a lot of those things are happening, you know, 3.5% for those sorts of things. um, you know, the again, that that supply is really driving everything though. So um anyway, guys, if you have any questions at all, always feel free to reach out to us. It's 480-788-8569. Call or text us there. My wife Cynthia and I would be happy to help you out, along with our preferred lending team. You can also check us out at mincolahomes.com, mincolagroup.com. Always email us at home@mincolagroup.com. And we will see you guys next time. Thanks a lot. We'll talk to you soon.